It's time for Jay. Good morning, good day, Jay. What's your view to markets?
Die Stummschaltung ist aufgehoben.
Good morning, Jens. Can you hear me all right?
Yes.
Okay, let me show my screen. Good morning, traders. Hope you're all doing well. Oh, here it is. Here it is here. Here it is here. Here we go. Here we go. Let's see what you are seeing. Yeah, okay. Risk disclaimer, picture of Jay, and headlines. Let's get started. Excellent trading opportunities due to volatility, due to emerging markets. We had a risk-off picture during the overnight session. Asian equities were red, sentiment soured. Why? Spillover concerns as the Turkish lira slumped once again. Recall, Goldman said at $7.2 lira, some European banks would get into trouble. We traded at offers were at 7.20, and then the central bank intervened, came out with some new margin requirements for swap transactions and a limit on what Turkish banks could do in terms of forex swap transactions, limited at 50% of their own equity. And as you know, banks globally are the most or are the highest leveraged institutes or companies that we can imagine. And they have very low equity, and to limit transactions to 50% in the swaps actually meant that the dollar Turkish lira came off a little bit. Nevertheless, we did see contagion into Indonesia, Mexican, and South African currencies. 10-year, we kept an eye on the US 10-year. We always do. It was at 287 at the time, and the dollar strength really started hitting home at over 96.40 at the time. So what does this all mean? It means currently that money is flowing into the US dollar due to several reasons. But currently, the number one reason is trade wars. China-US trade wars. US dollar seen as a safe haven in that regard. And that is very different from what it used to be. What it used to be historically was that trade wars would be negative for the US dollar. This time around, it's positive. So we always continue learning. Trade from last week, we wanted to go short pound versus Japanese yen. And we were hoping for a retracement to the POC to then sell it. And what happened? This is what actually happened. We never got a retracement. We had a low volume test higher, another low volume test higher, and this is it. There's a redistribution, we call it, and then off it went to the races. 45-degree angle, sustainable downward trend. It looked bleak. I did have one trader write to me on Facebook that he did take the trade, so he found a way into the trade. Fundamentally, the trade made absolute sense at the time. So what we are showing you here in terms of pairs, you may try to or attempt to find your way into positions. You don't have to necessarily go by what in fact, I don't want you to go what the picture or my entrances. I want you to find your own entries and exits. This morning we saw an overnight picture. This is the last 8 hours in terms of strength versus weakness, and over Twitter, all over the internet, and people are sending me their own currency strength versus weakness. That's all great, guys. Some of these are calculated using moving averages. We don't do that at all. This is calculated based on price, and that is why it's real time and not lagging, super reliable. And what we can see here is that overnight we had this risk of sentiment where the Japanese yen saw inflows. This is now currently changing again, and we saw outflows out of the Aussie dollar and also the euro. So the Aussie and the euro were getting hit by the Turkish lira story overnight. In the meantime, I made some money longing the euro in the futures market and made some money shorting the yen in the futures market. Risk events for this week. What's on the docket? Let's see. We have tomorrow fixed asset investment in China. That's important to us, and industrial production. Then we have preliminary German GDP. And as I always say, the name of the game is whichever investment bank most accurately predicts inflation expectations and GDP growth wins the year. So we see preliminary GDP Q&Q expected to be a little bit higher than last time. And then we have out of the UK, and I will allude to that in a little bit more detail later on, average earnings index. So let's see if wages are increasing. Then we have the flash GDP. That is the first reading. There are usually 3 readings of GDP, and the flash GDP for the Eurozone, Q&Q 0.3 versus 0.3 expected. That's the first one, so it has the highest impact. Then we have the ZEW economic sentiment indicator, a little bit better than last time, expected to come in. In the US, we have mortgage delinquencies. We are keeping an eye on mortgages. We are keeping an eye on new loan applications for mortgages, because housing in the US has become very unaffordable. And we are keeping an eye on auto loans and non-performing auto loans. And the last bit that we're keeping an eye on, and have been doing so for a while, is student loans. That is a big leveraged business in the US. And once housing, autos, and student loans go, then we'll have a bleak scenario at our hands. But currently, US is doing really well. Then on Wednesday, out of the UK, we have CPI. That's expected to tick up a little bit on the year-on-year basis. PPI a little bit lower, and then RPI in line. And then we go over to the US again. Core retail sales. Recall, the US consumer makes up about 2/3 of the GDP in the US. The US is still the strongest economy in the world, so we are really keen on keeping an eye on what the consumer is doing in the US. And then retail sales, we can see it right here, is expected to come in a little bit lower than last time. We have the non-farm productivity, we have unit labor costs, so similar to the UK earlier that week, we want to see, do wages tick up? Is labor becoming more expensive for employers? We do know that input costs are on the rise, and that means that PPI rising means that there will, most producers, if they can, pass on these increased costs to the consumers, which would then eventually lead to an upticking CPI. But we also recall that the Fed said we are completely fine with inflation numbers running hot for a little longer, way above our 2% target, which they currently do. All right, so we need to keep this in mind. And then on Thursday, out of Australia, we see employment numbers. Very important for us to differentiate there between full-time new employment, which are higher quality than part-time new employment. And we want to see full-time increase, but as you can see here already, there are some effects, and it's not looking too good compared to last time. Retail sales, similar story out of the US, similar to the US. We have retail sales expected to come in a little bit higher than last time, and we will spend some time on the UK later on. And then we have building permits. It's a leading indicator in the US. Expect to come in a little bit better than last time. Housing starts, same story. And then we have unemployment claims. I was almost going to say, as usual, around the 215,000 mark. Nothing new there. Final CPI on Friday out of the Eurozone. That's expected to come in at 2.1. And then we have Canadian dollar. Canadian dollar looks quite weak, and inflation numbers are ticking down. So what you want to keep an eye on out of Canada is the median and the trim. This is what the Bank of Canada keeps an eye on, not so much the headline number. And then last but not least, we have our friends from the University of Michigan giving us their sentiment indicator on Friday. That is expected to tick up a little bit once more. Let's dig down real quick, a little bit deeper. Come on, into the pound scenario. I wanted to spend some time on the pound because it got hammered last week. As we said, on Tuesday, we have average earnings. That's this index, and it's expected to come in 2.5 on the headline. And then there's this component that investment bankers or bankers and fund managers look at. It's called ex-bonus average earnings, expected to remain at 2.7. And then we recall, or you may not recall, McCafferty was one of the guys on the MPC who has recently left. And then before he left, he said he expects this number to take up to 4% in 2019. So 2.5, 2.7% We are really far away from 2019. The bank from 4%. The Bank of England is expected to raise rates twice more in the next 2 years, and approximately, or the market's expectation is for 1 rate hike per year. So that would mean for 2018 we're done. Well, let's keep an eye on that. Then we have also on Tuesday the unemployment rate, or the labor market numbers, and unemployment rate expected to come in line. And then our friends over at RBC wrote this. They suggest a month-on-month gain in employment in June in the region of 100,000 new employment would be necessary to maintain the pace of headline job growth at around the same pace as in the prior 2 months. So we need to see this number. Otherwise, expect a little bit further pound weakness. Wednesday CPI, 2.5 versus 2.4. The core metric set to remain at 1.9 as the effects from the post-referendum decline in pound continues to dissipate. Okay, what does this mean? UK is an island, right? Anytime you see pound weakness, there's a high correlation that the FTSE 100, i.e. their equity index, is rising. Anytime, it's similar to Japan, also being an island, right? We did see strength in the yen overnight, and if you take a look at the Japanese equity market, it came off. So that correlation is in place. If they go both the same way, that's an important and relevant information that the market is giving to you. And your first question then needs to be why? Why are they both going in the same way? And what does that mean for me in terms of trade and risk to my trade, and where is a trade? Back to the numbers. On Thursday, we have retail sales. Expect to come in a little bit higher. Then I actually went in, and people keep calling. It's unbelievable. Sorry, guys. I actually dug into the last report, and because I needed to refresh my memory. And if you guys don't know how to get the last report, that's quite easy. That's Thursday, right? You go on a Thursday. Where's UK? Where's pound? Pound leading index. Maybe it was Friday. What's wrong with me? Thursday retail sales, pound. Thursday retail sales, pound. So you click on this, and then you go to latest release, and then you look at the July 19 release for the month of June, and then you look through the qualitative aspect, all right? That's the kind of stuff that I teach traders to do, because that's where the money is. It's in the detail. The detail. All right. So in the last report, food stores saw the strongest 3-month over 3-month growth since May 2001 at 2.2 due to good weather and World Cup celebrations. Now ask yourself a logical question. World Cup still going on? Nope. Weather? Quite hot. In fact, over here, too hot to go shopping. So is not too really coming in, or might it come in later, lower? If it comes in lower, but you see the pound being lifted, based on a withdrawal of liquidity to higher levels, good opportunity to short back into it. But no action from the Bank of England expected until next year means currently anything related to Brexit is more in focus than the economic numbers. So if you're a day trader and you don't have live news, please don't do that. Please dig in and get some live news feed, because as a day trader, we need to hear what's happening in the market. Then with Brexit in mind, the short sterling curve, so that's the short end of the curve. This is actually yields we're now talking about, has continued to flatten. That is not good for equities over the past week, with some touting the possibility of inversion, with questions beginning to mount over whether the next move from the Bank of England will be a rate hike or a rate cut. The market starts pricing in a rate cut, the pound would come off. But if the curve continues to flatten into month end, you would actually see the FTSE coming off, and that would then mean that they're going to start buying some pounds. So you need to be careful with continuing to short and short and short the pound. You need to understand who's doing what in the market. Can't really teach you in 20 minutes in a morning meeting where you guys all want to see a trade, but I do once in a while try to give you bits and pieces of relevant information so that you can learn. Commitment of traders, Aussie on its way to a long, and we're probably a long way away from the long. I looked at the options market, and the 6A. The next barrier is down at 0.7050. So that baby may drop a lot further. Swiss franc long bias, Kiwi on its way to a long signal, similar story. We had one of you guys last time in here, no, it was twice ago, and I was really impressed. He said super bearish on Kiwi, and I'm sure he's making a lot of money. If you're in here today, I'm sorry, and I apologize, I forgot your name. Please recall to double in or to increase risk into your winners. Yeah, don't take position off. Start building the position. Really put the pedal to the metal because you are in the right trade. Volatility is increasing from 679 to 85 on the euro. Pound increasing. Yen increasing. And that all has to make sense. And this one was the one we talked about last time. We said unbelievably how low volatility is priced on the equity market. We were top edge in the ES. We saw the skew rise and then boom, volatility increased. Maybe some of you made some money of that. I'm hoping so. Option pricing for this morning, bullish, dollar CAD and gold, and bearish euro dollar, dollar yen, Aussie dollar, euro yen, euro pound, and euro Swissy. Option flows for this morning, bullish, pound, yen, and gold. Gold and gold, interesting. But why can you not really long gold off of the bottom edge here necessarily? Because of the dollar strength. The Dixie is just very, very strong. As long as dollar goes up, you don't want to buy gold on bottom edges. You need to wait. If the dollar comes off, then you go ahead and you buy gold. Bearish on Monday London session is Aussie, Canadian dollar, and euro. And I said it early on, Canadian dollar looks pretty weak. I would keep an eye on the Canadian dollars. Not really that much of interest to me at the moment because Aussie and Canadian futures are range bound at bottom edges. But I keep an eye on if I can hit that baby. Potential trades for this week. Short Aussie yen. We continue to see renminbi weakness. And this morning, once more, People Bank of China refrained from liquidity operations / injections. And we have the US-China trade war that keeps on escalating. So we have risk of potential due to a trade war. And also what's positive for the Japanese yen is A, that 10-year yields look to be allowed to go all the way up to 0.2%, and B, that the GDP numbers came in higher than expected, and the yen actually for the first time in a long time started reacting to an economic number. We threw a party here at the office. We thought this is great because it had deteriorated to just being a risk on risk off currency. The risk to our trade is naturally that we would have a risk on sentiment. And this morning, I did see that the market sentiment in late London started to shift a little bit. So I'm eager to see what the New York boys will do and girls, sorry. And we could see risk on creeping into the market. Nevertheless, there's a difference between a session sentiment and what's going on overall in the market. It's summer, low liquidity. We always expected shit to hit the fan, and it's hitting the fan. There you go. So the background is weak. The other risk is naturally that the economic numbers this week, Wednesday wage price index and Thursday employment numbers, may come in much better than expected. But I'm interested in shorting Aussie yen. It's just really, really weak. Here's the opportunity. In my opinion, short right now at the POC. Just be aggressive about it if you want. And then there's a volume point of control a little bit higher. Don't even know if we would get there because there's a roll reversal prior to it around 80 spot 60. 80 spot 60 is a roll reversal. So it's a sell zone. I could go for it now. I could go for it a little bit higher. It's a sustainable trend. These are the hardest trends to get into. Sometimes you just got to close your eyes and go for it. But then I saw another trade that I wanted to show you real quick, and that's longing pound versus Aussie dollar. It's really interesting to me that the pound saw some strength off of its bottom edges. I wouldn't get married to this trade, but it looks like we call this a before she goes trade, right? There's some liquidity above, and before she goes means we long into this, hoping that it will break out and all of the stops above will actually trigger, and people that shorted off of the top edge up here will be underwater and will be forced to actually cover their position. That means new additional aggressive market buy orders are coming into the market. And then I gave you a target around 176, the figure. Okay, hope that makes sense. I appreciate you all coming in. We see that participation is increasing again. I really appreciate you guys coming in here on a Monday morning, and it disciplines me in going through the routine and preparing everything for you guys and making sure that we have what's going on for the week on the radar in terms of economic numbers. Last week, last sentence from my side, last week we didn't really have much economic numbers. We did have the RBA, that was a non-event, but we had the RBNZ, the Central Bank of New Zealand, and they moved their future next interest rate move out from Q1 2019 to Q4 2019. That was a no-brainer, selling the New Zealand dollar. That is a no-brainer, okay? So if something like this happens, you hit the sell button. And anyone who did it, especially this one gentleman last time around, congratulations. I'm sure you made some good money, but you were already short. So my point is that could have been an opportunity for you to increase your short position. You can make your year on trades like that. If you catch the right trend and you keep adding to your winner, that is how you make money. You always press your winners. Always press your winners. Don't take profits during winning trades. Build them out. Okay, that's it from my side. Jens, I appreciate the opportunity. And, sorry, Thomas was asking a question. How about crude oil inventories on Wednesday? Thomas, very good question, but that is trading oil. It's funny that you say that. I made a 28-minute video on trading oil on Friday and sent it out to my traders over the weekend. And that's precisely it. You always want to put in mark on your chart the oil inventory levels. And what we did see last week is that we traded down to a bottom edge. Oil turned around there, and then it hit right back into the inventory level. The other thing, I don't know if you're new or not to us here in the morning. Thanks for joining, by the way, Thomas, is that oil tends to move in $1,000 moves, right? So the oil inventory level is, yes, of interest to us, but overall it's much more important to see if oil in general is rising or if it is dropping, because oil we take as an inflation input variable, right? So if you have a rising oil market, that is actually adding to potential inflation expectations from the interest rate players, i.e. the bond traders. Does that make sense? It's not something that we trade here in this Monday morning move, but the oil per se, but I do trade oil frequently, actually every week. How do you join a trader course? Mick, I only teach German-speaking traders for now. Maybe one day, if I have the time, I would build the course out. I actually mentor them, Mick. We spend 3 days together. They have to go through a video course ahead of time. Later on, then we spend 3 to 4 months together, trading every day, trading every week. Thanks for your question. If you guys are ever interested in that, I might take a quarter off and build it out in English and then do it webinar based. The problem is, once you do something on a webinar, it's out there on the internet and gets copied right and left. And what my experience is that there's a lot of people teaching how to trade who've never really been in an investment bank as a trader. And also, only because you are an investment bank trader or have been doesn't mean you're any good. My former head of trading this morning said to me, he's at UniCredit now. He said, why is UniCredit suffering the equity? We have nothing to do with Turkey. That is the lowest and dumbest and stupidest thing that anyone can say working at UniCredit. That means you don't give a shit about your profession. UniCredit and BBVA, the Spanish bank, have the largest holdings in Turkish banks. So they have huge exposure to Turkey and the shit that's going on there. And it's precisely that stuff why I then eventually left these types of banks and fought my way to get into Lehman Brothers, tier 1 banks, because the quality of the people and the traders there is just worlds apart. So just because someone has been at a bank doesn't mean he's good. If you meet somebody who was a Goldman or a Lehman or Bear Stearns, rest assured they're super. And I'm probably, I mean, it sounds like I'm an asshole because I was working there, but it means you're really good. Otherwise, you will never get into top tier banks like that ever. Forget about it. Okay, I'm babbling on, make some money. There's lots of volatility. I'm back to trading as well. See for the day traders if New York changes the sentiment. Okay, maybe the ES will make an attempt at new highs, but keep an eye on volatility. It means we can make some money this week. I'm looking forward to seeing you all again next Monday, and thank you for joining. Trade smart, live free. Jens, back to you, sir.
Thank you, Jay. Tomorrow is another day. We have 5 days a week, 5 different traders. So join us tomorrow again, same time if you like. And if you'd like to see that again, a couple of hours later, it will be available on our YouTube channel. So youtube.com/ADMIRalMarketsFX, and you will find it again there. Thank you and have a nice day and all the time good trades.